Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at XPENG.
And hey, if you find our talks useful, please consider hitting that subscribe button, maybe leave a like or a comment underneath. It really helps us out.
It really does.
And of course, if there's any stock you want us to look into, just drop it in the comment section below.
So let's get into the analysis. For you, the listener, understanding XPENG right now, it isn't just about looking at some quarterly numbers.
No.
It's about grasping a really critical inflection point in their whole story. They're moving from being, an ambitious startup to a truly scalable company.
And you see that so clearly in the Q3 2025 results.
You really do.
That's the starting point for the whole bullish case, really. And it was a blockbuster quarter. The revenue growth was outstanding, a 101.8% surge year over year.
And, when a company is operating at this kind of scale, seeing triple-digit growth, it's not just a nice number on a spreadsheet.
Right. It fundamentally shifts the entire narrative.
Exactly. It suggests they're grabbing significant market share from competitors in what is, let's be honest, a very crowded Chinese EV market.
Absolutely. And if you dig into where that revenue came from, the picture gets even clearer.
The primary driver, and this is the incredible part, was a 149% surge in vehicle deliveries year over year.
149%.
Yeah. And that number tells you two things at once. First, that consumer demand for their new models is, it's robust. And second, their manufacturing, their entire supply chain, it's scalable.
They can actually meet that surging demand, which isn't a given.
Not at all.
Okay, so that's the top line. But, the big question that's always hung over XPENG and a lot of EV companies really has been, can they actually make money on the cars?
The path to profitability.
It's been tough. Lots of high initial losses.
And that's where the Q3 data gives us the most crucial insight. Look, the company isn't profitable yet, but the trajectory, it's moving much faster than I think people expected.
Oh.
They posted a net loss of, RMB 0.38 billion in Q3. Now, that number is significant because it's a huge improvement from the RMB 0.48 billion loss they had just the quarter before.
So it's the acceleration towards break-in that has investors so focused.
That's it. That sequential improvement.
That's impressive. But you mentioned an inflection point earlier. Is it just the net loss getting smaller, or is there something more fundamental happening with their unit economics?
It is absolutely the unit economics. And this is the financial nugget you really need to focus on. Gross margin.
Okay.
XPENG's gross margin improved significantly. It hit 20.1% in Q3.
20.1%. Now, in a hyper-competitive industry like EVs, that's a huge structural win.
It's massive. Why is 20.1% the magic number? Well, it signifies that they've finally hit enough scale and cost discipline to start generating real cash from their operations.
And that puts them on par with or even ahead of some of their key competitors in China.
It does. And this isn't just a one-off bump. This suggests they've optimized their bill of materials, the cost of batteries, components, and they're really leveraging their platform technology.
So this is structural, not just a one-time cost-cutting thing.
Exactly. We know it's structural because this is now the 7th consecutive quarter of vehicle gross margin improvement.
7 quarters.
That consistency is crucial. It tells you that every time they scale up production, the cost to make each car goes down. It's that classic operational leverage playing out.
That's a powerful story. But to support this kind of growth, you need a rock-solid foundation. Let's talk about the balance sheet, because rapid expansion can burn through cash so fast.
You're right to bring that up. But despite the massive R&D spend, their financial foundation is healthy. They have substantial liquidity, and this is key, manageable debt.
And why does that matter to an investor right now?
Well, having that cash buffer gives you two things. First, the capacity to keep investing aggressively in R&D, which is their future. And second, resilience. If there's a market shock or a sales slowdown, they aren't in a position where they need to panic and raise capital.
We also saw some moves on the governance side. It can sound a bit dry, but it's so important for institutional confidence.
It signals corporate maturation. They filed a Form S-8 for their 2025 share incentive scheme.
And for listeners who aren't familiar, S-8 is basically for employee stock options.
Right. It shows management is really committed to retaining their top talent. They want to make sure their best engineers and AI developers stick around for the long haul. They're protecting their intellectual capital.
They also appointed an independent non-executive director. Another sign of them just, growing up as a company.
Standardizing their oversight, yeah.
Okay, so they've stabilized operations, fixed the margins, they have the cash. But the real reason investors are excited about this, the core of the whole high-risk, high-reward idea, it's not just about selling cars, is it?
Not at all. It's the technology moat they're building. If the Q3 financials are the engine showing their current power, the pivot into AI-powered vehicles is what defines the next 5 years.
They're positioning themselves as an AI company that just happens to make cars.
That's their core long-term thesis, and it's how they're challenging giants like Tesla head-on.
And they're backing this up with their own hardware, right? This isn't just some off-the-shelf software.
No, this is proprietary tech. It's centered on two things. First, their own Turing AI chips for in-vehicle processing.
Customized chips.
Right, customized for the demands of autonomous driving. And second, they're using an advanced AI model called the Vision Language Action Model, or VLA.
So what does a VLA model do that's so different from, the basic driver assist systems we see in every other car?
The VLA model is designed to go beyond simple pre-programmed reactions. It processes complex, real-world visual and linguistic data, the vision and language parts, to decide on the best action.
So it's like allowing the car to truly understand a situation, not just react to lines on a road.
Precisely. It's what you need to get to level 4 autonomy.
And this is where the story gets really interesting, to me at least. The ambition level.
Right.
They're not just making SUVs. They have this incredibly aggressive roadmap. We're talking humanoid robots
and most critically, a Robotaxi rollout planned for 2026.
Isn't 2026 for a full Robotaxi launch? I mean, isn't that wildly optimistic? The regulatory hurdles alone seem massive.
It is aggressive, yes. And the execution risk is high, which we'll get to. But if, and it's a big if they hit that 2026 timeline, even in just a few major Chinese cities,
it gives them a huge first-mover advantage.
A potential first-mover advantage in a market that could completely redefine urban mobility. It changes their valuation from a car manufacturer to a tech services provider. That's why investors are willing to pay that premium.
Okay, let's unpack this from a technical perspective. We have these incredible fundamentals, this ambitious future. What are the charts telling us about how investors are feeling right now?
Well, the technical snapshot is interesting. The stock's trading around $21.89, so it's holding the upper half of its 52-week range, which is roughly between, say, $11 and $28.
So the momentum from that strong Q3 report has mostly held up.
It has, but there's been some profit-taking. We saw that pullback of nearly 8% after earnings.
So is that a warning sign? Or is that just healthy consolidation?
Most analysts see it as consolidation after a really strong rally. When a stock jumps like that, short-term traders take profits. It's normal.
And where's the support level?
Technically, we expect strong support to hold in that $20 to $21 range. If it stays above that, the bullish trend is still very much intact. On the upside, you've got resistance in the $26 to $28 range.
Okay, what about momentum indicators? Are we looking at a potential breakout soon?
The indicators, specifically the RSI and the MACD, they're sitting in what I'd call neutral to bullish territory.
So not overbought yet.
Exactly. For listeners, that just means there's still room for buyers to push the price higher without triggering an immediate reversal. The MACD confirms this, so the underlying trend is still positive despite that little pullback.
So the chart is kind of coiled, ready for a breakout. But that breakout probably needs some news. Which brings us, I guess, to the risks.
Right. Despite all this fantastic growth, the valuation already reflects really high expectations.
It does. The forward valuation is, well, it's high compared to global peers. Now, you can argue the Robotaxi potential justifies it, but a high valuation is a double-edged sword, isn't it?
Absolutely. It makes the stock incredibly sensitive to any disappointment. If they miss an earnings estimate, or if a tech promise like the VLA model gets delayed by even a quarter, the stock can get hit and get hit hard.
The market just demands perfection at these levels.
It does.
Let's talk about that execution risk. They're spending so aggressively. How does that R&D strain affect things in the near term?
That's the tightrope they're walking. They are pouring capital into AI, into hardware, into global expansion. If that investment doesn't turn into clear monetization, say, the Robotaxi fleet gets delayed by regulators,
then that spending could really weigh on their profitability.
It could. They have to keep demonstrating that margin expansion we talked about, that 20.1% gross margin, even while they're spending this much on R&D. They just can't afford to see those margins dip.
And the competition, especially in China, it's brutal. They're not just sitting still.
No, it's intensifying. You have fierce rivalry from global players, but also critically from local Chinese OEMs who are just as aggressive. And sometimes they're willing to sacrifice margins just to gain volume.
Which could pressure prices.
It could force XPeng to lower their average selling prices or offer more incentives. Execution is just paramount in a market this saturated.
Okay. High risk, high reward. Let's look at the catalysts. What should our listeners be watching for in the short term, say, the next 3 months?
The immediate focus has to be the Q4 2025 earnings release. We're expecting that in February 2026.
And based on their guidance, we're expecting continued top-line growth.
We are. But the real test will be the margin figure. We need to see that gross margin staying at, or ideally, improving on that 20.1% mark. That would confirm the recovery is systemic, not a fluke.
And beyond the financials, this is a stock that moves on innovation news. What speculative news flow could cause a sudden re-rating?
You should be watching for specific updates on the Robotaxi pilots. Are they adding more cities? Are they hitting key regulatory milestones? Also, look for more rollouts of their AI platforms.
But the biggest immediate driver could be partnerships, right? Management has hinted at them.
Yes, unconfirmed rumors about new OEM or tech partnerships. A major deal with a global auto giant or a big tech company would be external validation of their technology stack.
And that could trigger a substantial re-rating pretty much instantly.
Almost instantly, because it validates their whole transition from just a niche vehicle maker to a global technology supplier.
So let's bring it back to the long game. The structural drivers that make this a multi-year story.
It all comes down to successfully commercializing their technology. It's those two big drivers. First, the Robotaxi fleet launch in 2026. That's a massive new high-margin growth vector.
And the second driver.
Is the AI monetization strategy. The long-term vision isn't about selling a car once. It's about selling scalable, high-margin recurring revenue through their proprietary chips and software subscriptions.
The classic tech monetization model.
Exactly. If they pull that off, they transition from being valued like a car company to being valued like a high-margin tech services company. That is the transformation investors are betting on.
So we have a company showing strong operational leverage, hitting critical margin goals in a very tough market. They've got the funding, they have the ambition, but they face immense execution risk.
And the final thought is this. XPeng has, I think, undeniably achieved a critical inflection point with its gross margins. It's proving its operational model works. However, for you, the investor, the decision really rests on your conviction in their ability to execute that aggressive 2026 AI and Robotaxi roadmap. That execution is what will ultimately determine if today's premium valuation is justified.